There's going to be probably you're going to hear more and more things about stagflation, meaning growth is increasing, but inflation just can't keep a lid on that. So what they did is the Federal Reserve came out and they didn't do anything with interest rates. We predicted that. They did come out with the dot plot. I'm going to show you that. We had kind of, I found it behind the scenes kind of. I'm going to show you where the dot plot's going to take us, because what you're going to start seeing at this point, you're going to see the headlines reading this. Fed holds rates steady, stays on track for 2 cuts in 2025. And you're sitting here thinking, okay, 2 cuts, they didn't do anything now. They're really not projected to do anything here in the near future, because in 41 days they're going to meet again. What are they going to do? If you scroll down and look at the probabilities, well, the federal funds rate right now is 4.25 to 4.5. You're seeing that right through here. And to prove that to you, let's get over to the, here's what the Federal Reserve monitors. And we're going to go through each one of these, because I'm going to break it down what they expect these things to go to and why they really didn't do anything with the rates just yet. But they are predicting 2 rate cuts. But right through here, here's the federal funds rate. And this is the interest rate the Federal Reserve controls. Okay, this is it. They don't really have a direct impact on your car loans and credit cards. This is short-term lending, but short-term lending for banks. So if a bank needs funds, they can lend money from they can get money from other banks, and basically that's the rate they charge. So when the bank's prices or rates go up, intermingling, they're going to increase the rates to us as well. So they'll increase short-term rates like credit card rates, car loans, personal loans, and things like that. Mortgage rates are tied to bonds. So we're going to take a little bit of a deeper dive into the bond market here shortly, but I just want to go through some of the notes. These are the things the Federal Reserve said about these numbers that are coming up, and there wasn't really much change in their verbiage. They continue to say, let's go to my notes. Okay, so here's what their notes read. The economy, they said it's solid. That was basically their terminology. Jobs are okay right now. They haven't fallen off a cliff, and the jobs unemployment rate is staying sticky right through here. And they had no mention of it. Let's see. No. They have no indications of this going up, but they're saying it's basically an okay jobs market right now. Then they're saying on the GDP, we had a negative 0.2 last time, but they're saying it is going to, well, actually the GDP year over year was supposed to be between 2 and 4%. Depends on what analysts you watch, but they just came out today and they expect the GDP to be at 1.4 for this year. So this won't be negative. This will be positive. So if you look at it, you're saying inflation's at 2.1. They want this at 2. You have an unemployment rate. It's usually like around 4%. Well, it's 4.2. That's not bad. And you'll have GDP at 1.4. Nothing crazy, but it's also on track. So that's why they're saying, well, we don't know what's going to happen with tariffs. We don't know what's going to happen with the big, blue, beautiful bill